Hello, this is Rick Villaro, the Chief Investment Strategist at Pinnacle Advisory Group. I'm going to talk a little bit about why we think it's important to guard against the right side of the tail or the possibility that the market could melt up. There's really four main tenets to my case in terms of why we would guard against the right side of the tail. Number one, some of the banking risk is easing at the moment. Number two, there's increasing liquidity in the system. Number three, cyclical data is actually improving. And we think there may be some deep embedded pessimism within the markets right now. So let's take the first point here, which is banking risk is easing, and talk a little bit about it. And I think it's important to maybe take a walk back in time in terms of history here as to really get some context for why this is so important. So the first chart that we're going to put up is a chart of Lehman Brothers credit default swaps. Now, a credit default swap sounds like a very Wall Street type of jargon, confusing, but it's really not, and I'm going to explain what it is in just a few simple words. Credit default swap price is almost like an insurance policy. So if an investor wants to buy a bond and insure against that bond defaulting on the debt, they can buy a credit default swap, and if the bond defaults, they can get paid back, just like an insurance policy would pay you back. Now, just like any other insurance policy, it has a premium. And essentially, the more the market thinks that a company could go out of business, the higher that premium is. And so the chart that you're looking at shows you two things. It shows this, what I would call insurance policy, or the credit default swap, and it shows the actual premium pricing on the left. So the higher the line is going, the more expensive it is to insure against default. And I think what's important is if you go back to 2008, when there was a lot of problems in the credit markets on the U.S. side of the equation, you can see how this line is making its way higher throughout 2008. And it's kind of ebbing and flowing a little bit. And then when we get to September of 2008, you have a real surge up to over 6% on the price of the premium of the CDS. And essentially, we know what happens then, right? Lehman Brothers goes out of business. That essentially shuts down the entire banking system. The banking system flows right into the generalized economy and shuts that down, freezes it basically, and we end up with, the worst recession since the Great Depression and one of the worst bear markets that we've ever had in history. So you can appreciate that last year, we're going to fast forward now too. Again, we began to get worried about the banking system. But this time it's not really in the US, it's in the European banking system. And so we're watching names and insurance policies on those names that are delivering similar results to what we had seen during Lehman Brothers. And this is one example we're going to show you. This is one bank in Italy called UniCredit. It actually happens to be the largest bank in Italy. Which is a very big market. It's the third biggest bond market in the world in Italy. It's a material market. So I think what's interesting is if you look at the pattern on this chart, it's very similar to what you saw in Lehman Brothers, where we had some activity. There's a rising in prices of the insurance over time. And then late, into the fall last year, we have a real surge in the price of the credit default swap. And so from our perspective, we thought, things were getting very hairy in the European banking system. We were probably getting very close to another Lehman-like moment where some bank somewhere was defaulting. And I can tell you that it wasn't just UniCredit that we were watching this chart pattern occur on. It was lots of banks. You could have looked in France at SocGen. You could have looked in Germany at Deutsche Bank. There were many banks doing the same thing to give us a message that there was risk in the system that banks could basically shut down again. All right, let me turn this around, though, and tell you why I think maybe some things have changed here for the positive. In other words, we're talking about defending against the right side of the tail, or perhaps the risk that the markets could melt up if the right things happen here. So what happened to make this equation look a little nicer for us? Well, I think two things last year occurred that might have been game changers for the market. Number one, we had a coordinated currency swap go off among central banks across the globe. That occurred November 30th of last year. Now, what did this do in English? This essentially basically reduced the cost of dollars and dollar funding to the European banking system. And why is that important? It's important really because even though these banks operate overseas, most transactions today still go off in US dollars. And so when liquidity gets tight and these dollars go up in price, that was putting a lot of pressure on the banks that were already having solvency issues. So that was one thing we thought was very good. Number two, maybe just as important or more important, was the fact that the European Central Bank entered into what was called a long-term refinancing operation. And essentially what they did here was they provided a 3-year loan to the banks, a lifeline, if you will, of almost 500 billion euros, over $600 billion, that essentially said, look, if you were a bank, you could trade in almost whatever collateral you wanted to the ECB, and you could get this loan for 3 years at very low rates. So again, if you had problems in the solvency within the system, this was to alleviate some of those solvency problems. And it really didn't take long for the two of these policy arrangements to take effect. And lo and behold, very soon after these two interventions occurred, we saw a real material drop in some of the insurance pricing for the on these banks. So the reality is that last year's posture was to defend against the left side of the tail. But this year, given that some of the banking risk is coming out of the system, we think that could really get markets a little bit more confident and lead to that right side of the tail being in play as well. So secondly, let's get to liquidity. So we talked about the banking risk coming off the boil. The second point here is that there's just massive amounts of liquidity across the globe, and it's being basically put online by the central banks across the world. So I don't think it's so surprising that our U.S. Central Bank is pumping money into the system. We all know that we have a chairman in Ben Bernanke who is the biggest fighter of deflation that we could ever have. In fact, if you want to go Google it, he actually wrote a paper back in 2002 called Deflation, making sure it doesn't happen here. And what's interesting in that paper is he basically outlined back then a number of the unconventional measures that he's been deploying here since 2008. And by those I mean quantitative easing. Okay, remember that occurred during 2008. We had a quantitative easing 2 program. These are both programs where we're buying bonds essentially to try to push rates down. Most recently, there's something called Operation Twist, where they're kind of selling short-term bonds to buy longer-term bonds. All unconventional measures to try to push yields down in an attempt to foster growth within the economy and to push people into risk assets and make them feel wealthier. That's not all that surprising that we continue to lift the size of the balance sheet in the U.S., but maybe what's really important here is to note that the entire globe has jumped in. The whole world has gone Bernanke in essence. And so basically I'm going to put a couple of other charts here. One of them is for the Bank of England, that's in yellow, and the other one is for the ECB, the European Central Bank. And you can see essentially on these charts that the balance sheets of these central banks has exploded lately. So in the last quarter or so, we've had the ECB and the Bank of England jump in and really just complement what the Fed's doing. Now, it was just those two, that's one thing. But the reality is if you lined up the world's 6 largest central banks, so it's the 3 I'm showing, the Fed, the Bank of England, the ECB, if we put China on there, the Swiss National Bank, and maybe Japan, you'd be up to about $13 trillion out there, floating out there in reserves. And what we won't argue here at Pinnacle is that this doesn't look like the best thing structurally for the long term of the economy. But what we would say is that in the shorter term, over the next 6 months, a year, this could really prop asset prices. And you might have a couple bubbles build in the interim, even though this is not that healthy long term. So if you're looking for that right side of the tail again and why it might push up, central bank liquidity and total assets is one reason it might go up. In addition to the actual central bank, in the developed world, we're doing all sorts of unconventional measures like quantitative easing programs. We also have a complete change in the monetary cycle of the emerging markets. So a year ago, we had a situation where China and many of the emerging markets were raising their interest rates in an attempt to cut off inflation. Essentially policies that were not good for growth, but they were trying to cut the inflation in the system. As we enter, as we look ahead today, we're in a 180-degree different spot in terms of what's happening in the emerging markets. So they've now turned tail and they are cutting their interest rates to defend growth. And that is a major, major thing that's going on here. So not only is China cutting their reserve requirements, and that's what you're seeing on the screen, they've now cut by about 1% as of the time of taping. But we also have emerging markets across the globe that have started rate cutting campaigns. And so essentially, between the size of the central bank balance sheets moving up and this change in policy stance that the emerging markets have had, we have just a sea of liquidity sloshing around the system. And again, that may just feed into asset prices, produce some sort of a bubble. That's what we're talking about on the right side of the tail. All right, let's get to the third point, which was economic data. The reality is that the cyclical data around the globe has been better than expected over the last quarter or so. I'm going to start in the U.S. Here at Pinnacle, we cover hundreds and hundreds of data points every month. We obviously don't have time in a presentation like this to present them all to you, but we're going to give you just a few of these in terms of the highlights of some of the data that we think is getting better. And the first thing I would go to is jobs. The job front here in the U.S. is critical. If we ever want to get into what's called the virtuous cycle, where jobs are picking up, incomes are going up, people are spending. If people are spending, it's good for businesses. If businesses are doing well, they hire more people. There's capital spending going off. If we ever want to get to this virtuous cycle where an economy feeds off of itself, we really need steady jobs. And it's very encouraging that over the last quarter or so in the U.S., the jobs market is actually picking up. The actual metric on your screen is something called the U.S. Initial Jobless Claims. It comes out every week and essentially just measures the number of people lining up to claim a benefit from the government because they're out of work. And it's very encouraging if you look at the green line to watch how that line is trending down in a very positive direction. So more people beginning to get work, that means less people lining up for that claim or that benefit. The other thing on the screen that might be notable is you can see blocked out in red the 4 boxes. Those just represent recessions in the past. And so that you can see here, the general trend is as you get into a recession and people are losing their jobs, these claims numbers really ramp up a lot. And then usually in the wake of the recession, as you begin to cyclically improve, things are getting a little better. Normally you get into a nice downtrend here. And I think you're seeing a pattern that's been repeated many times in history occur right now. And if it's to continue here, that could bode very well for the U.S. job market going forward. Second thing I want to talk about is housing, just a little bit. Now, housing's been a maligned market here for probably 6 years or so. And I really think it's quite interesting to think about the fact that before 2006, there was not many economists you could run into or analysts that would tell you that the U.S. housing market could ever go down. But now here we sit, after about a 6-year bear market in housing, and it's very hard to find anybody who thinks the housing market can go up. But the data lately actually paints a different picture. And again, we follow a wide series of data here at Pinnacle. We look at all the different metrics, whether it's existing home sales or building permits, new home sales. There's tons of them. But what I have here is one data point on the screen called the National Association of Home Builders Housing Market Index, which is seen as a pretty good leading indicator of what's going on in the market. And across the bottom of that screen, you're reading readings from 22 to 29. It's just the reading of the actual index. The higher it goes, the better. That's all you need to know. And what's interesting about this is lately, people have gotten so pessimistic that they just can't even keep pace with the data that's out there. So to give you an example here, for this particular data point, there were 51 different analysts estimating on what the number would be. And you can see the large cluster of those estimates were somewhere between 25, 26 on the number. It's a little more, a decent amount in 27. And then around the periphery, that was that. The number that actually came out was a 29. So out of 51 economists, not one of the economists was positive enough on this number. So we're not going to sit here and argue that the housing market's about to break out and have a great cyclical run here. But I think what's important is that if the housing market is just beginning to find a footing that, and can just start to solidly bottom and maybe tick up slowly, that could be a real benefit for the U.S. economy. Because a lot of people forget that, housing is very good for the economy on multiple levels. Number one, it's most people's biggest asset. So it has a wealth effect attached to it. So it's important from that perspective. Number two, there's many jobs that get levered off of housing. So it has a real multiplier effect within the economy. So the bottom line is here, despite all of the negativity out there in housing, here's another data point coming in well ahead of expectations, and that's good news. All right, the last thing I'm going to go to is Europe. And I think we've certainly been in a cycle here where it's been, all Europe all the time and mostly negative in the headlines. And a lot of that's for good reason. But I think a lot of folks might be surprised that lately the economic data that's actually coming out again is exceeding analyst expectations. What you have here on the screen is what's called the Citigroup European Surprise Index. And essentially all this thing does is it just tracks every data point that comes out on a European basis. And we'll basically track whether or not the data point that comes out is better than the analyst expectations or is worse than expectations. And what's interesting on this chart is since December really of last year, you can see how the line gets green and over the 0 point. That means that on balance, the data points that's coming out of Europe are exceeding expectations. And I don't think the mainstream media is mostly picking this up. There's still a lot of negativity in Europe, but I will say that if you can get a continuation here with data actually exceeding expectations in Europe, boy, that could be a huge boost to confidence. And so just even in Europe, I think that you have to pay attention to the cyclical data, and it's improving. All right, we're going to skip from cyclical data now and get to the last data point, which was that it may be some deep embedded pessimism in the markets. And I think if you're, making the case that there's at least some chance that you could have an outsized gain in markets, you'd have to come up with some fuel to produce, those types of gains that we're talking about here. So what I have here is a chart of what's called the ICI mutual fund flows. You can get this right online. It's public data. And all we did was break out two asset classes. Very simple here. In blue, you have equities, mutual fund flows into equities. And in green, we have mutual fund flows that are going into bonds. And I think what's very interesting, now on the left side of this chart that you're looking at, you can see positive numbers going up from zero in millions. That just means that, those numbers are flowing into, money is actually flowing in if you see positive to the asset class. And if it's getting negative, money is flowing out of that asset class. And what you see if you look at it on this chart is just many, many months where the blue bars or the equity flows have been negative. On the other hand, you have many months here where the green flows or the bond inflows into the market have been positive. So I guess the case I would make here is that even though rates are very, very low, people have been so scared and so battered by what's gone on in the markets that they're willing to pick up very low yielding bonds at arguably, pretty poor valuation in lieu of equities. And that if there's anything to the data shifting up, and if confidence just picks up a little bit and you had some flow of funds from bonds to stocks, that's probably all you would need for another leg up in the markets on a material basis. So if you're looking for fuel, this is one potential point you could have that would point to fuel that could push the markets up a whole nother leg here. Maybe even back to the old highs of about 1560 on the S&P. All right, that's it for my talk here. I'm just going to wrap it up real quick. Why should we defend against the right side of the tail in our allocations right now? Really 4 reasons. Banking risk is easing. There's increasing liquidity in the system. The data is improving. And we think there may be some deep embedded pessimism in the market to provide fuel for another leg up.